Welcome, everybody. We're enjoying some technical difficulties over here. I don't know how you guys are doing. Angel, do you want to take it away for a minute here while I try and make this happen?
I can. So we are here for the REI Rocks review. This is where we go back into our vaults. We pick a session from one of the previous six summits, and we break it down. And we go through it. We stop it. We make some clarifications. And then we also give you our doggy bag at the end, which is your takeaways, right? So that maybe you have a better idea of how to find the key points in a presentation or in a summit session, so that you're not going into it so blindsided. Because I think some of us, we kind of forget, and we go back to that point in our lives where we're highlighting everything. I think about when I first started highlighting in my textbooks, and I would literally highlight everything because I couldn't figure out what was the important stuff that I should be taking away. And so if you are in a situation where you feel like everything is important, we're going to help you with our key takeaways, and maybe that'll in turn help you be able to really hone in on the important pieces that you should really be focusing on. I mean, what would you say, Jason?
I think you got it.
And that's my introverted husband.
That was amazing. That was really, really great. That was perfect. It was predictable. It went exactly like it was not planned, but oh man, that's really awesome. So we're talking. We're going through Dugan Kelly, who is he's a securities attorney. We're going through his presentation, and I always hated the word syndication, and I'm going to date myself, which is something I try not to do. But whenever I hear syndication, I think like WKRP in Cincinnati.
Or
I think
MASH.
syndicated radio station. Yeah, MASH. Yeah, just like and yeah, it shows like that, but like specifically like like when you have like TV channels or radio stations that are just another version of the same thing. And so like I think that the word syndication, it's a big word, it's a scary word, and I think it's part of the problem of why this stuff is confusing is because they use a ridiculous word for it. So who wants to? I've teed that one up. Who wants to take that idea? What's
Jason?
So I also think of syndication. Remember that movie Payback with Mel Gibson?
Yeah.
And they had the syndicate that was
Oh.
Yeah. I always think
organized crime.
I thought organized crime.
Yeah, a criminal syndicate. Yeah, like that doesn't even make any sense with the different versions of like. Does it? Like I know what a syndication is, and I know what they mean when they're talking about TV stations and radio stations, but why would they choose that word, criminal syndicate?
I have no idea. But when I think about a show or a radio show, a TV show, a radio show that's being syndicated,
yeah,
even that isn't the same as what we're doing in the syndication.
Yeah.
I mean,
Gilligan's Island.
In a syndication, we are pooling, like a group of people are getting together, they're pooling their funds, and they're buying properties that they would not be able to buy any other way.
Mm-hmm.
But when when it's like a syndication of a show, that just means it's in lots of different outlets. So I think that it's another just example of English and
because
how a single word can mean so many different things.
Right, because the local syndicated channels, it just basically means like the CBS has stations all over America, but they're not like it basically means a franchise as far as I can think of, but they still call it
well, and that's one of the things that I've loved about. And I was gonna say that's one of the things that I've loved about Yona's challenge. So if you're not doing Yona Weiss's LinkedIn challenge, you're missing out. Yes, it is an absolute full-time job for 2 weeks. Insane. There's so many things you're posting on, but your exposure goes through the roof. And there are plenty of people out there that are posting educational content where they're going term by term and they're explaining it in layman's terms. So I've always told my classes, you can't speak the language if you don't know what the words mean. And so if you really want to be able to speak intelligently in this space, you really should be looking at what these people are posting right now, because it's amazing. Like, I'm looking at these terminologies, I'm like, oh my God, I never knew that's what it meant. Because like they just explain it a different way, and it clarifies my own understanding. And not that I've been in this a ton of time, but it's just a really great place to learn. And then you get massive exposure, and that's a positioning thing. So if you're able to position yourself amongst all of these experts, you are perceived as an expert before you ever are one. So, and I'm sure I've said that multiple times, but it is so very true. So
yeah, I really love what you're saying there. That's fantastic. And like, you have an academic background, and I do think that has to be brought into the conversation, because I think that like, if you've ever really been in the academic circle, a lot of what you end up hearing, it has to do with either insecurities or just lack of experience expressing yourself. And so one of the reasons why the choice of words, it's such a big thing for me is, I lived in Taiwan for 15 years. So it hit me. It's like, why are you using all these $50 words? You like, if you want to feel superior to someone, you just, talk to a wall. At least a wall doesn't have feelings. But that's my rant. All right. And we've got some people coming in here. Good Worm Buds, which was actually supposed to be Good Work Buds. So thanks for that, Paul. We're not drinking tequila. There's no worm at the bottom. I'm not sure what that typo was all about. We've also got Douglas, our friend Douglas Dowell's on here. So that's exciting stuff. So we're going to get started on today's video. Once again, we should remind you that we do play these at 1.5 times playback speed, which one of the things we want to do is we want to show you that that's possible, and also the benefits of gaining back some more of your day going at that increased speed. I always watch at 2 times speed. So this is, more like a jog sort of thing. But it takes time. You need to work on this. You need to try it out. So let's get this video started.
hey guys, welcome to day 2 Real Estate Investing Rocks Summit. And Dugan Kelly is starting us off today. And I don't know about you, but I have massive questions when it comes to raising money, especially in the 506B, because I have heard so many different things. So we're going to let him present first, and then I'm going to bombard him with probably a million questions, but I'll try to limit them in case y'all have questions too. So Dugan, I'm going to let you take over, and I'm going to stop.
All right. Thank you so much. Thanks for having me, everybody. So this is what I like to call the ABCs of syndication, but at the end of my presentation, I'll try to get through this as fast as I possibly can without jumbling everything. We're going to have time that you can ask anything you want about securities or real estate, or the kind of the interconnection between real estate and securities. So I'm the managing shareholder of a boutique national law firm called Kelly Clark. We're licensed in multiple states, but we're active all around the country. We represent real estate investors in all phases of the deal. Last year, I did over $4 billion in structured transactions for sponsors, operators, syndicators. Those terms are used interchangeably with one another. And then we also litigate. So in the unfortunate circumstance, if you find yourself in situations with on a deal that's going south, we have done that. So let's see here. All right. We all know how big the real estate market is, right? It is massive. On average, it's over $75 billion. That's why people like yourself are listening to this, right?
I want to say something about that, Angel. It looks like you got something to mention as well. So do you want to start it off?
I just think that when we're looking at those kind of numbers, it's really hard to wrap your head around them, because like usually we can wrap our heads around probably numbers about as big as what would fill a stadium, because you can envision how big a stadium is. And if a stadium holds 100,000 or 200,000 people, you can remember how many people that looked like. That's hundreds of thousands. This is freaking billions. How do you even wrap your head around that?
Well, there's been one thing going on in Toronto that has made that sort of arithmetic easy for me, which is that houses in Toronto for under $1 million don't exist. So really, it just makes me go, it's like, okay, how many houses in Toronto is that? That's my, like, I'm also Canadian, and we usually measure things in numbers of cases of beer. But, it's still early
Neither here nor
for
there.
that sort of thing.
So,
It's neither here nor
so
there.
what I do is I just remove like sets of zeros.
Yeah.
So I remove like the last 6 zeros. So that's 75,000. You can handle 75,000. And then just remember there's a million on it. 75,000 million.
Yikes.
Yeah. And the reason I paused it is because I was talking to Yasmin and Alay one, I think is her. I'll stop tripping over her name one of these days soon. But the conversation that we were having had to do with pursuing businesses or industries where there's actually money to be made. And the issue is like, you can't be a librarian and become really independently wealthy just because there's not that much money floating around in the library business. So that's one of the things I think is I think is under recognized in our education systems. They were told it's like, oh, you can be whatever you want, but it's not a means to the ends that I think a lot of people have in mind, and that's what people mean when they say, oh, well, you need to learn the math. Does anybody have anything to say on that, or are we ready to continue?
Ready to go.
Rock and roll.
Listening to a lawyer. Don't tune me out just because of that. But this, I'm passionate about it. And the reason why is because peak fortunes are being won and lost and saved through investing in commercial real estate. So your typical structure for a syndication involves you as the operator, syndicator, or a sponsor. Or if you're a passive investor, this is what you have seen when you've seen that big stack of legal documents sent to you via email to sign. Generally speaking, what we do is we create a new entity. That new entity is often a limited liability company. That limited liability company is sold off in part to passive investors. You're essentially raising money through passive investors. The money that you're raising is the equity you need to get the loan to get the keys to the apartment building or the self-storage facility.
Also, since it says 80-20 on the screen in very big numbers, we should mention that that's not all deals that are split in 80-20. You can do whatever your partners are willing to play along with, but I don't want people thinking that this is law or every single deal there.
Now there's lots of different splits. There's lots of different waterfall scenarios. And every deal is unique. So yeah, this is just easy numbers. And it's a sort of common split. So,
or the mobile home park, or the piece of raw land, or the development. It doesn't really matter what you're syndicating. The steps involved in it are relatively the same, regardless of the size of the transaction or the type of asset that you're syndicating. And so in this hypothetical, we've created a new limited liability company. We're going to sell off 80% of that new limited liability company to passive investors. The 20% is going to be retained by the sponsors, the operators, the syndicators, the people that actually put the deal together. That sometimes is referred to as the promote or the carried interest. That is going to be essentially who manages the asset on a day-to-day basis. Now, why do we care? Well, we care in part because there's this broad area of law out there called securities law, and that is governed by what we call the Securities and Exchange Commission. This is an independent government agency that is tasked with jurisdiction over all sorts of transactions, including syndications. And so the rule of thumb, if you're trying to think of, well, if what I'm doing, is this a security or not? The rule of thumb is if the seller's purpose, that means the operator, the general partner, the syndicator, the sponsor, the person asking the passive investor for some amount of money. If your purpose is raising capital, and the buyer's purpose, the passive investor, the limited partner, the Class A member or Class B member, depending on what you're investing into, is receiving profit, then it is probably a security. The chances that you would be engaged in something other than the sale of a security are relatively small. Now let's digress just slightly. If you're getting together.
That seemed fast to me. I don't know about you guys. Like obviously, we deal with this all the time, and so we got it locked, but like I don't think that was the fastest way or the easiest way to consume that. So I realize that there's a little bit of foot and mouth disease going on here, but as far as how you guys take it, like I know I have a go-to explanation of what constitutes selling a security, what a syndication is. And like, kudos to Dugan for using so many synonyms or terms that are used for the exact same thing in the explanation, but I think it got a little bit wordy, and so that's a little bit overwhelming, and I'd like to fence it in a little bit.
Yeah, I would say Jason's probably better explaining this than I am. So, just like you're talking like the split and how it gets carried onto the GP team, right?
Well, no, I'm more talking about, what is it when you sell a security? What is a syndication? And I think the simplest way of putting it is if somebody is doing work and another person is doing no work, but they're contributing capital so that they get some of the profit, okay, that is selling a security. And it doesn't matter if you call it a joint venture, it's still actually a syndication. And that's the nature of a syndication, is when you're taking passive investment.
So we're not selling securities.
We are selling securities, and we're doing it under exemptions, and that's what makes it legal, because you have to either have the license to be a broker dealer to sell a security, or you have to do it under an exemption like a 506B or a 506C or.
So you're selling shares in that offering.
Yeah, that's right. And that would be still a security, according to everything that I've heard from securities attorneys.
Yeah, I think one of our favorite LinkedIn lawyers says a JV. To be a real JV, each party has to have a substantial role. If one is just doing money, then that is a security. Otherwise, it could be a JV. So.
Right, exactly. You can't be just pretending with a JV. Yeah, you have to actually contribute somehow. So,
but then that makes me wonder about like silent partners and stuff like that. Is that really a thing, or is that just securities? Or
it makes sense to be only securities. I think about silent partners. Like I guess it really depends on if it's done contractually, or if it's just a preference on the part of somebody. But yet, how you could be completely passive and be on the GP team, it's a problem as far as the structures that I'm aware of. Oh, here we go. Okay, so Douglas is saying correct. A JV could be a security, but yeah, that silent partner part, that's a really interesting question, because it's not a term that they use in these presentations on securities. They don't say, oh, well, but if you're a silent partner and you're really good at miming, say your name is Marcel Marceau and you're in a business and you're trapped in a box and the box is getting small. All right, anyway, let's continue.
With some buddies and you're like, hey, there's a donut shop that I want to buy. And the donut shop, the equity necessary is $50,000 to get the loan. And there's 5 guys, and each of you are going to put in $10,000. And you're going to have an active role in that entity that owns and controls and operates the donut shop. That is not the sale of securities. So some clients all around the country ask me, hey, if I have a small deal, a very small deal where we're just going to use our own money and some friends are going to come in and they're going to use their own money and we're all going to own and operate this thing together, do I need a PPM? And the answer is no, you don't, because you're not selling securities. Each of you are going to do a capital contribution. That money's going to go in the hat, and each of you will have an active role. But in large part, most syndications throughout the United States, if you're syndicating something, the very definition of syndicating means you're going to pool other people's money into a pot. And that other people's money, they're not going to have an active role. They're relying on you as the sponsor, operator, syndicator to utilize their money that they're investing with you to place that into the deal. So it is a security in most instances. All right, here's where we get the definition. So I'm going to give you the long, lengthy, kind of arduous legal definition, and then you're going to remember that rule of thumb, right? So they qualify a security as assuming as a investment, assuming a reasonable expectation of profit derived from the entrepreneurial and managerial efforts of others. So boil it down, strip all that legal mumbo jumbo out of the way. And it's like, if you give somebody money and they are going to use their efforts to manage that money, to grow that money, to give you a return on that money, that is the sale of a security. And so that's why it's very broad. And that's why, frankly, you should care, right? Again, if you're offering, you want some of this, meaning you want a piece of this property that's owned by an LLC that I just created, and they're saying, yes, I do. I really like that. I like that asset. I think that your business plan is amazing. I want in. That's the sale of a security. And that really should be done only through what we call a private placement memorandum. The private placement memorandum, or PPM, maybe you've heard that, maybe many of you have even done it before, just means a broad definition of a bunch of smaller legal documents. That is the way that we legally engage in the sale of your securities in this thing. So, all right.
I just want to pause it there for a second because I want to emphasize that I know for a fact there are 5-figure courses out there that teach this stuff. And we seem to be live streaming it for free like a bunch of maniacs. And, like, of course, I think the other thing that jumps out to some people is we're looking at this video and they seem to be speaking fairly quickly, but that's because it is pre-recorded and we're watching it at 1.5 times speed. But we're doing that to show you, if I pull this up here, I'll put some triangles over my face. After I get rid of that, it's for, and I know we want to talk a little bit about the mastermind that's coming up now, but it's for, if I hit this, there we go. Now you can see the triangles and stuff on my screen here. We do have this subscription where you can access hundreds of hours of content just like this and consume it at 2 times speed, 1.5 times speed. It's a really effective way to learn. And the nice thing is there isn't a course that's being plugged through the entire process. Angel, Jason, do you want to say something about it?
Well, you can also watch it multiple times and back up and watch it again and take notes. And if you have any questions, these people presenting are real people, and you can always reach out to them too if you have questions. So
that's awesome, because I often get asked about retention, knowledge retention, especially because I talk about speed reading fairly frequently. And the fact is, if you're reviewing a single book or a piece of content multiple times, there's no way that someone else's retention is going to be better than yours if they've only blasted through it once. So it really is an effective use of time. And if you're watching at 2 times speed, you can do it twice in the same amount of time as the other person and probably retain way more. So I think it's really important. Angel, did you have more to add?
No, I think y'all got it all.
Sweet. Let's continue.
So what are the steps? So you've got potentially this idea. I'm going to go out and find something and we're going to try to syndicate it. Meaning we're going to pull other people's money together and we're going to do it. What should I be thinking about first? Well, first, obviously, is education, due diligence, and analyzing the deal. It always starts with analysis, deal analysis. I can't understate this enough. This is one of the most crucial aspects of anything, because if you go out and raise something, but you can't implement your business plan because what you bought or what you've won is a bad deal, it's bad for your investors. So analysis is first. Then it's the letter of intent, right? All of us that are in this have done this before. It's the drafting of a letter of intent and firing that out to try to hopefully win that beauty contest, to get to that best and final, to hopefully get the asset that you're going to syndicate. And then it's creating this purchase and sale agreement. And once that gets signed, then we're off to the races. And once you've gone through enough due diligence, we start to create what this legal framework for how you're going to raise money, how you're going to syndicate the equity necessary to get the debt, to get the asset. And that framework is in part creating the entity or entities that are going to function as the manager, the general partner in the deal, as well as the actual borrower of the money, the entity that's going to be sold off to investors, creating your business plan, and ultimately all of the other documents that go into the private placement memorandum. So let's talk about that. There are 6 ingredients, and only 6 ingredients. And it doesn't matter if you're investing into like $1 billion mixed use development through a PPM, or you decided that you're going to syndicate that $50,000 donut shop. The ingredients are the same. So I represent a lot of high net worth family offices, individuals, investors. And when I am looking at a deal and vetting that for them, I, as their counsel, am also looking at whether these ingredients are present in the offering. And so you, as the operator, syndicator, sponsor that's putting this together, regardless of what the asset is that you're going to syndicate, you need to have these 6 ingredients in there. One is disclosures, and this is also called the risks. What are the risks associated with the investment, right? Nothing is risk-free. But the reality is, if you allow your money just to sit in a bank account, it's sleeping, it's not moving, it's not growing. You're not going to create any financial wealth for you or for your family or leave a legacy. But it's so important that you disclose all of the risks associated with the transaction. Now comes the sizzle, right? We talked about what the risks are, but every offering also has to have the business plan, the pro forma. Some people call this the marketing deck. That's super important. That's often what you see if you've attended a webinar. Somebody's pushed an invite to you and you have an opportunity and you've seen that in that slide deck. Well, that's the business plan. That's their hopes, the operator, syndicator, sponsors' hopes to actually implement throughout the life cycle of the asset. Third is what we call the investor questionnaire, or what the SEC refers to as suitability. Not every investment is suitable for every type of investor. If you have an offering that is limited only to accredited investors, somebody who doesn't meet the economic or net worth thresholds of what an accredited investor is, it is not suitable for them to invest in that opportunity. And that's where you ideally find that out, is through that suitability process. It's mostly done through a questionnaire in the process. Number 4, when we talk about a subscription agreement, what is that? All that really means is it's a legally binding part of the PPM. It basically says, sponsor and operator say to passive investor, I'm willing to sell you this piece of my company for X. $20,000, $50,000, $75,000, whatever the minimum investment is, that's typically what's set forth in that subscription agreement. And likewise, the passive investor is signing that subscription agreement saying, I'm in. I want to buy X of the company for 25, 50, 75, whatever it is. The most important document, though, often is the company agreement. This is often the limited partnership agreement or the operating agreement if they're members in an LLC. This is the only legally governing document that it will exist after the raise is closed. So the asset is purchased, we've closed, woo! The investors, though, are thinking to themselves, what's the agreement that governs when I get my distributions? What's the agreement that governs when the exit plan is? What voting rights do I have, if any, right? Who are the managers and what are the lenders' requirements? All of that is included in that company agreement. And you, as the sponsor, operator, syndicator, are going to sign that, and so is each and every one of your passive investors. And then, most importantly, if you're the sponsors, where's the money, right? You need the money from the investors, so don't forget about that. So you need to have your logistical payment processing set up so that it is easy for the investors to fund their investment. Now, if you don't see these ingredients, if you're a passive investor and you don't see these ingredients in the offering, regardless of how it's packaged, right? Because all of us that operate in this space may have different styles of what the PPM looks like, right? But the reality is all the PPMs need to have these ingredients. And if they don't, it's a warning sign. And I would say even go so far as some of these are so indispensable that I would not invest. For instance, if they don't have a company agreement, I would not invest in that. So it's important for you as a passive investor to know what type of ingredients to expect, and you as an operator to know that these ingredients have to be in your offering for anything, regardless of whether you're doing a 506B or a 506C. It doesn't matter. These are the same ingredients. All right, let's talk about different types of investors, right? We know we've got this asset. We've created an entity. We're going to sell off 80% of it to passive investors. We want to know what type of investors are we looking for? Well, in general, what we're trying to find are accredited investors, or in some cases, if we do a 506B offering, we're looking for a certain limited amount of what the SEC calls a sophisticated investor. So an accredited investor from an entity perspective, the only one that frankly will largely apply to what you're doing is LLCs, trusts, or other entities that have at least $5 million of assets. If they have $5 million of assets, regardless of whether all the owners of the LLC or the trust or the company are accredited investors, the entity is an accredited investor. Okay. What about a person? How about they're not investing through an entity? What should I be looking for if I'm looking to find out if an individual is an accredited investor? Anyone whose net worth is north, meaning higher than $1 million, when you back out the primary value of their primary residence, is an accredited investor. So think about this. Why would the SEC do something like that? Well, think about it. If the vast majority of the population in the United States is not accredited, right? We want the 1% that are accredited. We want them to make sure that they're not counting for their net worth the biggest asset that most of us own, and that's our primary residence. So if you back out the value of your primary residence, and then you take all your other assets and all your other liabilities, and if the net value is over $1 million, the SEC believes that you are in a better position to protect yourself from unscrupulous operators, syndicators, sponsors of deals out there. So you have to have over $1 million net worth backing out the value of your primary residence, or you can make $200,000 or $300,000 in combination with your spouse in the last 2 taxable years, with the reasonable expectation of making that in this year, the year that you're going to invest. If you can answer yes to any of those categories, then you are an accredited investor. Recently, the SEC has started to expand its definition of what an accredited investor actually means, which is great for you as sponsors, operators, and syndicators. Why are they doing that? Well, groups that have historically been disenfranchised, women, people of color, groups that largely have not had access to private equity or to be able to do private placement offerings, they want to expand the definition so that they get more participation, not less. And so one of the things in which they've done that is expanded to the fact that, let's say you have an LLC that is created to invest in opportunities, and you have managers or executive officers of that company, but they might not be making $200,000 or $300,000. They might not have a net worth of $1 million. But the SEC says if they are a knowledgeable employee the last 12 months, they will qualify as an accredited investor. This is really good for a lot of people out there. All right. What's the other big category, right?
Can you hold on real quick, though? So I think it's important to understand that if you're getting that additional inclusion into accredited, it's for the previous 12 months. So you can't jump on a GP as a sophisticated investor, be that GP and say, okay, now I'm accredited, because I don't believe it works that way.
Yeah, the ones that I heard is that if you have, it's like director level or above, but you have to really have knowledge of the deal. And I heard that you're accredited, but only in the context of that deal. So it doesn't even translate to, like, it doesn't even open you up to investing under a 506C separately, even though you do have that accredited status for your own deal.
Yeah, but it sounds like from what he just said, once 12 months have passed with you in that role, then you are accredited to be used in other fashions.
Interesting. Right.
That may be a question we should push further to some other maybe lawyer friends or somebody that can help us out with that. But that's the way I understand it. But the easier one for me is just, you got that series license, yeah, you get to be accredited too.
Right. Or you know, the net worth or the of course it's not like, it's like, well, why don't you just start making more than $200,000 a year, silly?
Because that's hard.
It's a little bit of one of those more easily said than done sorts of things. Yeah.
Well, our personal opinion is that it's easier to meet the 1 million net worth mark than it is to meet the yearly earnings mark.
Yeah. I think that's very fair. And the other reason I wanted to pause for a second is just to talk about, well, one is this QR code for the mastermind if people want to apply for that and get with these groups. But I think one thing that needs to be emphasized is, like, out of all of the investors I've met, I would say that fewer than 15% I would describe as confident in their understanding of how a 506B is actually supposed to work.
Yeah.
It's like, it's really unusual. And like in my chance encounters, like one of the questions I always do is say, like, okay, well, we all have our own unique skill sets. So who are you most able to help? But I warn them, if you have a 506B raise going on right now, make sure you don't entice investors, whatever that means. And sometimes they'll just still go ahead and do it anyway. And I think that's just indicative of how these requirements are tough to understand. And I think that's problematic personally. Like if it's that difficult for people to like if you can literally just hear the instructions, don't entice investors, but they don't realize, like, well, I'm looking for passive investors. It's like you just did the thing that you're not supposed to do.
Yeah.
But really, it's selling the security itself that I found is the actual controlled act, where so it's not actually public solicitation. But of course, the SEC has to be like, well, if you're using an exemption that says no public solicitation, you can't have it both ways. And that's where I think people are getting so confused. But
yeah, absolutely.
It's so much to unwrap, though. It's really, really bonkers. But anyway, let's keep going.
The other category is this thing called a sophisticated investor. Well, what the heck does that mean? Well, what we know is that the SEC gives us, again, a very kind of convoluted definition of what a sophisticated investor. Sophisticated investors, according to part of the SEC's definition, have knowledge and experience in business matters to evaluate the risks and merits of an investment. The SEC exempts small companies from registering certain securities sold to these investors. What does that mean? Well, it really means that if you can answer, in my opinion, if you can answer these three questions, then you have established a sophisticated investor in your portfolio. One is, does the investor, from you, the sponsor operator, could they tolerate the total loss of their investment? Meaning, if the business plan fails and the property is potentially foreclosed on, horrible, right? And that's one of the risks associated with the investment. But if they could tolerate it, meaning they're not going to be paying for their investment through food stamps or EBT cards or things like that. Then we get to the second question. Are they buying this investment for themselves and not for someone else? Remember, this is not a fix and flip opportunity. These are what we call restricted securities. They are meant to be bought by you, the passive investor, for your own account and not for somebody else. And then 3, most importantly, yes, they obviously understand your business plan, the merits of potential investing, but more importantly, from the SEC's perspective, do they understand the risks associated with the investment? If you can answer those 3 questions as the sponsor when you're determining somebody coming into a deal, and they're able to answer those theoretically, they are a sophisticated investor. And you are allowed on a 506B to have up to 35 of those people. Okay, what are the?
So the thing that I think needs to be emphasized is that it's our job, or whoever issues a security, it's our job to say no to people who are not appropriate. And I think that's what it doesn't get emphasized enough when you're learning these things. Is that something you guys want to? Is there anything else to add?
Yeah, I would like to just also add to that the reason why these things are set in play is so that someone, and I've run into this myself, someone doesn't come to you that is willing to put their whole life savings with you because they trust you or they like you. And it is our responsibility to say, hey, I can't take that. Because honestly, some funds are simply too expensive. And you don't ever want to be in a situation where this deal goes sideways, because the reality is that you could lose all of your investment money. That's the nature of an investment, is that possibility, right? That you could lose it all. And so these laws are set in place so that a sophisticated investor who knows what you're doing, they understand the business plan, they understand all of those pieces, they don't wind up in a situation where they lose everything.
Mm-hmm. Mm-hmm. Yeah, that's beautiful. Jason, did you have something to add?
No, I was going to say that we have had to turn some investors down because we knew their situation and we couldn't tie up their money for 3 to 5 years when they may need it next month. Mm-hmm. So,
and I think that comes along too with knowing your investors, because you need to know your investors.
Mm-hmm. And I think what you're implying is something that many of us coming from normal W-2s or whatever else have run into when we learn about the difference between an accredited investor and a non-accredited investor, and what that means in terms of which investments are available to you. It's tough not to feel targeted and just basically saying it's like, okay, well, you don't make enough money, so you couldn't possibly be smart enough to handle something like this. And that's not what's going on at all. And even if you are pretty jaded as you're going through it, I don't think you can learn all of it and still keep that belief that it's basically, well, if I'm going to be colorful, it's not flipping the bird to poor people that's going on here. That's not what's going on at all.
The other types of ways in which you potentially could get either accredited investors or sophisticated investors. Well, the only other way, if you are not personally, your deal, you're not selling your own securities, the only other way in which you can get passive investors to invest in your deal is through the use of a registered broker dealer. What the heck is that? Well, there are specialized individuals out there that hold securities licenses that they are allowed to receive a commission-based fee for finding qualified, accredited, and or sophisticated investors for your deal. The SEC, has these broad definitions of who a broker and who a dealer is, but it's basically people that have specialized securities licenses, and they are also belonging to what we call an SRO. SRO is a self-regulatory organization. The biggest in the country is FINRA. These people have given jurisdiction over themselves, their livelihood, to FINRA, meaning FINRA regulates them, they supervise them, they qualify and restrict them. And so from the SEC's perspective, a registered broker-dealer is a safe person within which to actually go and raise capital for your deal. But you are exempt from having to register as a broker-dealer. Why? because you are considered what we call the issuer. The issuer is that LLC. Remember that LLC that we're selling off 80% of and we're keeping 20% for the sponsors? That's the issuer of the securities. This is your deal. You are a person associated with the issuer. You fall into what we call the issuer exemption. That issuer exemption exempts you from having to publicly register your offering. And so if it is not your deal and you are raising for somebody else, don't do that, right? Unless you are a registered broker dealer. All right, the issuer exemption, a little bit more about this. All it means when you boil it down is,
can you
is
pause
this your
that real
deal?
quick?
So there's lots of people out there.
Okay, so I think this is where I come to when I say there's no such thing as a co-GP. You're either on the GP team or you're an LP. And I think that that's a really important distinction because lots of people call themselves co-GPs. There's plenty of portals that when you have lots of people dealing in things, only the leads get called the GPs. Everybody else is called co-sponsors or co-GPs. And it's not a real term.
On the portals, I've seen co-sponsor, not co-GP. But even one of our favorite LinkedIn lawyers says there's no such thing as a co-GP.
Yeah. So just watch yourself. Do some CYA. Everybody will tell you, I say everybody, a lot of people in the space are going to tell you the easiest way to get on a team is to raise capital. Just watch out. Because if you're going to raise capital, you have to also have a substantial role other than just raising capital.
Unless you're a broker.
Right.
Unless you're a broker dealer.
Right. Exactly. Yeah. The same internet attorney, he also mentioned that you should not use the term, I'm a capital raiser, because it's basically a smoking gun that you have no intention of actually, putting forth any real effort to the running of the asset. And that's what you're not supposed to do, because that's basically what a limited partner is anyway. So you don't get to have it both ways. It's basically one way that I think makes sense of putting it. All right, rock and roll.
That have multiple general partners or multiple co-sponsors on a deal that they're syndicating. That's fine. But the reality is, are those multiple co-sponsors, general partners, are they legitimately a part of the deal? Meaning, is it their deal just like it's your deal? That does not mean that you have to have some sort of socialistic, everyone gets the same compensation regardless of what you do on the deal. But what it does mean is that regardless of your compensation, you are performing the functions or have the ability to perform the functions as a legitimate general partner, a legitimate co-sponsor on the deal. Ideally, you have that worked out ahead of time before you get into the throes of actually raising capital. And the bottom line is, if this is not your deal, then you really need to be a registered broker dealer for it to apply. All right, is your syndication exempt from public registration? Well, registered brokers and dealers, they are already registered with the SEC and they and with the self-regulatory organization. You do not have to register. You personally do not have to register with the SEC or with the self-regulatory organization because you are an issuer. And if you're an issuer, you're exempt from that. All right, let's talk about regulation, Reg D of Rule 506. Okay, most people that syndicate, regardless of the asset, but particularly in what we call the triumvirate of the non-recourse debt assets, multifamily, mobile home, self-storage, right? Those kind of are happy bedfellows, if you will, in the asset class around the country. And most people that syndicate in the Reg D space, they do so of Rule 506B or 506C. These are exemptions, again, from having to publicly register your offering. Right? We're talking about private offerings. This whole idea of syndication people are engaged in creating entities. It's not surreptitious or weird or bizarre. This is a very, very significant way in which people can actually move, buy, and sell assets and capital around the country in the commercial real estate space. But B and C, Rule 506 B and C, are the primary exemptions that people use in the syndication space. So what are the differences? What are some of the key differences between a Reg D 506B and 506C? Well, preliminarily, I want you to remember that 506B is what we call the historical rule. This is what we've always lived with. So since I've been practicing law over 20 plus years, this is what we lived with. In 2013, with the passage of the Jobs Act under President Obama, there came into fruition this idea that Rule 506C was going to be there. That's the new kid on the block. Well, what's the difference between the historical rule of 506B and the new kid of 506C? Well, primarily advertising. The reality was before 506C, issuers, associated people with the issuer, were not able to advertise their deal, their opportunity. Throw it out to Facebook, to their 3,000 BFFs, that we're raising capital, we're closing on a deal. You couldn't do that. 506C, the SEC says, you want to advertise?
There's one thing that I think never gets mentioned in all of these. Like we do say it's like, okay, it's to protect, like grandma from getting swindled out of her life savings. But like the question of like, why do they force people to register at all? I don't think that is really addressed. And I don't know if you guys have spent a lot of time thinking about that and you have good ideas, but I can take it away if you don't. So what's the deal? Like why wouldn't they let people advertise like by default? Like why isn't it where somebody can just say, I'm going to buy that building if you want to, chip in?
I think it goes back
just
to
let
that
me know.
protection. No, it goes back to that protection of people that. So the idea, I believe, is that an accredited investor can lose $50,000, $100,000 and it's going to hurt, but they're going to survive. Someone that's not at that level, if they lose $50,000, $100,000, that could be it for them. They could now be back to paycheck or worse. And so the reason in my mind why you can't advertise is because you need to know your investors. The accredited ones, they can handle it, but you have to know your investors well enough to know who's not accredited and who needs more support.
Jason, did you have 2 cents?
No, I don't have anything else to add.
Okay, because the ones that I think have to be brought up, like especially because of the inflation over the last couple years, I think it's made it really, really obvious the role of real estate in economies where people don't perceive the currency as being worth as much. Like the real estate people realize it's just like the Monopoly games that we play on Friday nights, right? It's there's only one way to stay in the game, and that's if you're receiving rents. It's you can try and be frugal or whatever or lucky, but it's not going to work. But I really do think that one of the main things that the SEC is up to is reducing the amount of speculation that occurs. And if you can just turn around and like everybody can be in any deal they want and it's all willy-nilly, then what I think would end up happening is that, my entire life, people have complained about the price of real estate. And I don't think that that's ever going to change. I don't think it's changed in a couple thousand years. So really, I think that they do have to keep a real firm grip on speculation. And because I do think that the tenants are the ones who suffer when there's too much, like if people are playing it too close to the wire, if there's a $50,000 or $150,000 hit to the property and insurance is dragging their feet, like do the tenants who've been paying in good faith, do they deserve to live in a place in disrepair just because, you bit off more than you can chew? I don't think so. So I do think there is a noble backing of all this kind of stuff. And that's really what I wanted to mention. So, but if you want to hear me go on and on about this kind of stuff for free, and Angel and Jason, the best place to meet up is on Mondays, Marvelous Mondays. Angel, do you want to tell everybody exactly how marvelous the Marvelous Mondays are?
Well, the Mondays are marvelous. It's a great way to start the week. It's a marvelous way to start your week. And we'd love to see you there. It's a really great family of regulars that we get together every Monday and we just hang out for an hour or so. There's generally an after party. So if you're tied up from 12 to 1 Eastern, try the link anyway. We're probably still there. We hang out for a bit because we've gotten to be really good friends. And we would just love to have you come be a part of it.
Excellent. And you can do that by either like typing all that stuff on my screen over here and over here. I can do it two-hander here. That's fun. So if you could type that into your browser, or this QR code right here. This is taking way more hand-eye coordination than I expected. But if you take your phone and you scan that code. That all
Let
that
me
just
get
sends
that
you to
code.
that.
What?
Yeah, exactly. Just like that. You just give it a blip, and then they'll send you there to the registration page. We only do the registration, so we have some sort of documentation of it. It's not for anything like mass marketing. So we'd love to see you. We have lots of great pals, lots of syndicators, lots of operators, all that kind of stuff who are regulars. And, we get attorneys, all kinds of figures in this business. So it's a good time and definitely worth your time. So
100%.
let's do it.
We want to loosen up this idea that we want to make capital and investing more accessible to people that have been largely disenfranchised. We don't just want the richest of the rich to be able to do this. We don't just want corporations to be able to syndicate their deals. We want to open it up to common. We want to open it up to the Main Street, people like us that can actually do this and actually invest into deals. Well, the reality is the SEC says if you're going to do a 506C because you want to advertise, you're going to be limited. You're going to be limited because you can only have accredited investors in your deal. You cannot have sophisticated investors. Remember that on 506B, the historical rule, we have up to 35 sophisticated investors that are not considered accredited investors, but by their business, education, or acumen, they qualify as a sophisticated investor. But 506B, we still can't advertise. 506C, want to put your face on a bus bench? Fine, you can do that under 506C, but you're going to be limited to accredited investors only. The accreditation process. Here's the next big component of difference.
The other thing to add would be that it would also compete directly with Wall Street. And like that can't not be part of the equation. But, really, like even with a Reg A raise, you're talking a lot more money to be able to do that. And so if you're talking about a property that's only like a couple $1 million or something like that, it's just not really practical to be spending, like $75K on the initial applications and then $20K a year just to be running that Reg A plus. These are a lot more reasonable, and it's supposed to be like, you and your pals.
Yeah. Well, and I would also say too, like if you go a 506C route, there are accredited investors out there that may not even know they're accredited. But for the ones that are accredited, they may not know what a syndication is. So one of the things we like about doing 506B is that it doesn't change who we talk to. We're still going to talk to our friends that we know to be accredited investors, but it allows us to really know our investors and educate them along the way. If they don't need the education, they can bow out. They can still invest with the deal and not be a part of the educational process. But if they need the educational piece too, we're there to give it to them. And it just helps us really get to know our investors. And I think it's super important, especially when you're starting out, to know your investors. So even if we eventually get to the point where we're doing a bunch of 506Cs, I still want to know my investors.
I love that. Okay, we're putting it.
Historical rule. People that invest with us, we already know them, right? We don't need to advertise. They're not strangers to us. We know them. So therefore, we can trust what they say when they say they are accredited or they are sophisticated on the questionnaire. We can trust that because the SEC's perspective is they're not going to lie to you because they're your friends. They like, know, and trust you. So you can accept what they say. On 506C, because we're advertising, the SEC puts an additional requirement on your investors, and that is they are strangers to you. You may not necessarily trust what they say. So if they are going to invest with you, the SEC says you need to personally, independently verify that they are as rich as they say they are, meaning you can't just trust what they put on a questionnaire. Most people accomplish, meaning sponsors accomplish this accreditation, this independent accreditation through a variety of ways. The most likely way is to get a letter from the investor's CPA, their lawyer, or their registered broker-dealer. If you as the sponsor are doing a 506C offering and you get a letter from the potential investor CPA, their registered lawyer, or their registered broker-dealer saying, yes, my client or customer is an accredited investor, you can take it to the bank. Great. That's what you need. If you're not able to get that, then what you're doing is this painstaking process of either outsourcing to another entity or individuals who will verify through the use of reviewing tax returns, certified financial records, or other types of statements that would independently be able to verify. Remember that their net worth is something greater than $1 million, backing out the value of their primary residence, or that they've earned at least $200,000 or $300,000 with their spouse in the last 2 taxable years. That's those
Yeah, and that's a lot of stuff, right? Like if you own stuff all over the country, there might even have to be like appraisals involved if you're like close to the cutoff. But from what I understand, it's not quite as bad as the feel that I had there from Dugan, because like I do know some CPAs who do this, and it's like in the $50 range, but of course, like getting all your paperwork together, it's a hassle. And I think it probably stops some people from bothering to sign on the dotted line. Whereas with 506B, as long as like in their questionnaire, they don't say, are you accredited? Yes. And then, JK, LOL, I'm broke AF.
Actually,
that's,
we had somebody that said they weren't sophisticated or accredited. Turned
right.
out they were accredited and sophisticated, more sophisticated than they thought they were, but didn't understand what those terms meant.
Oh, okay. So, and they weren't like, for the record, they weren't like eating crayons or something.
It was a doctor.
A doctor. Yeah. Excellent.
But
Yeah.
it took, he's a friend of ours, and we went through some education. We talked to him, and it was clear that he's invested even in housing before. So he understood. He didn't understand those terms as the way they were being used.
Right. Yeah.
That's why you need to know your investors.
Right. Exactly. And just feel free to ask if you're talking to like a deal sponsor or something like that. It's their job to make sure that you understand the questions. So just go ahead and ask. It's like, hey, I don't know if I'm sophisticated or not. Please teach me a wise one.
Yeah.
Those are the key differences. And then on disclosures, you have on a 506C to decide on what information you're going to provide to investors, because they're all accredited. On 506B, you have to have obviously certain disclosures to make sure that you're not violating any fraud. Bottom line is, don't lie, don't cheat, don't steal, and share the same information with all your investors, regardless of whether you're doing a 506B or a 506C. So those are the main differences between those. I want to touch briefly on a recent development that came out from the SEC that bears on whether you can engage in advertising, and that's called solicitation of interest. This is called testing the waters, or Rule 241. Rule 241 that came out from the SEC allows you, as the sponsor, operator, syndicator, if you have an asset under contract and you have not, I repeat, you have not decided which exemption you're going to use. You haven't decided whether you're going to do 506C and advertise, or you're going to do the historical rule 506B and not advertise, but yet allow up to 35 sophisticated, qualified investors to participate. You can engage in this test the waters, which allows you to advertise the possibility of engaging in a private offering, as long as your advertisement or your solicitation has disclaimers on it. And these are the disclaimers that the SEC is wanting, that the company, meaning remember your LLC that you've created, is considering an exempt offering, but has not determined the specific exemption it will rely on. The specific exemptions would be 506B or 506C in our hypothetical. No money or other considerations being solicited, and if sent, will not be accepted. So if you push out this and somebody says, I'm in, and they send you their check, you're going to send that back to them. No sales will be made or commitments to purchase accepted until the company determines the exemption to be relied on. And then a prospective purchaser's indication of interest is non-binding. So if you're testing the waters and you're trying to do soft commits, right? You're having soft commits from some of your investors. The reality is that is not going to be binding on them. So that's a very interesting. And if you are a sponsor or operator that thinks to yourself, I want to know whether a 506C or a 506B might be appropriate, but yet, have the ability to potentially engage in solicitation before you determine that, Rule 241 is significant for you. All right.
So I guess right there, the main thing is I just recognize that, there are laws involved here. You do have to know what's coming up before you really get involved in all this kind of stuff.
And it's important to make the distinction that testing the waters is different from being a 506B and a 506C. You can have both B and C in a single offering. But when you're testing the waters, even if you have your deal, you're not, the deal isn't really being offered. It's being like, I don't know, like almost carrot dangled to see who's going to go after it. But you're not taking funds. You're not really soliciting the deal. You're just kind of seeing where things would land. So that is completely different from doing the 506B and 506C together on a single deal.
Right. And one part I was gapping out on that I wanted to include is I think you should not even think about being an issuer unless you're mentally prepared to send those checks back or to turn around to a wire and say, nope, I do not accept those funds. It's really unusual to be like, oh, you want to give me money? No. But that has to be in your toolbox. You have to be ready to do that. So, there you go.
Let's talk briefly about an uncomfortable topic, but important one. And that is, does the SEC really care if I go out and hire a bunch of capital raisers? Yes, they really do care. Don't do it. Capital raisers, or the nomenclature in our business is capital raisers, or people that are not registered broker dealers, and this is not their deal. They are called unregistered finders, and using them on your deal and then with the expectation that you're going to give them something, whether it's equity or cash, is not appropriate. Your contracts potentially could be ripped up. Anyone helping you could be guilty of a statutory thing. There are risks to the finder. That's the people that are actually going out and doing this. There are risks to the issuer engaged in this, and then there are rescission risks, meaning the actual deal will get ripped up. Imagine if you used an illegal finder, but they weren't able to do anything, and yet you raised all the capital legally, compliantly, and your file gets audited. The whole deal could be torn up simply because you engaged in that behavior. So again, if you're going to participate on a deal, or you're going to have multiple co-sponsors or general partners, they actually have to have a significant, substantial role in the deal other than just raising capital. Okay. Each state. So remember, the SEC is a national government agency that is based out of Washington, D.C., but each state has its own state securities board. And those are what governs what we call blue sky laws. So you need to be aware of the fact that your offering has to be compliant with both the national securities laws as well as the state specific securities laws associated with this.
And that's another thing that I think is really confusing for people is like any like big developer, big syndicator, $1 billion in assets, like and up, like any of those people, they're still raising capital. So like it's not like it's not okay to raise capital. That's totally fine. It's just you can't raise capital and nothing else. It's
yeah.
I don't know. No wonder why people are confused.
And I think there's a flip side to that too. You can be a part of a deal that maybe the timing was off and you weren't able to bring any capital to the deal.
Mm-hmm.
So it's not an either or situation, because some people think, oh, I'll just bring capital and I'll be fine, because there's people that don't bring anything at all and they're fine. But that's not the reality of the situation. On a GP team, everybody should be trying to raise funds. And that's one of the things that we've been very fortunate with, is that we've been able to raise in-house. So that's just been, we've been fortunate to do that and not have to reach outside to ask for help or ask for additional people to come onto our team.
So important.
All right. But aside from all of those risks, the reality is you're saying to yourself, why bother? Why should I even do this? Can I do this? And the answer is yes. Whether you are listening to this right now and you've only ever done one deal that you've syndicated, or whether you've done 100 deals that you've syndicated, the reality is you can do this. You can build a great team. You can, if you need to get qualified or accredited investors through the use of surrogates, hire a registered broker dealer. You can build your list and your network. You can do this. There's no doubt in my mind. Over the last 20 plus years, I have seen a variety of personalities and people do this. And it is not just for a certain type of individual, or where you were born, or the color of your skin, or what your bank account is. It does not matter. The fact is, anyone can do this if you can build relationships and be successful at it. All right, I'm going to leave you with these final thoughts, and then I'm going to answer any questions that anyone might have. And the reason why I end with this is that I have this poster. Every morning I come into my office, I have this poster. I look at this thing to remind myself of the challenges that life presents, and in particular, the challenges that life will present to you if you decide to do this, or if you are currently doing this. And so I hope that this ministers to you as it ministers to me. All right. People are often unreasonable, irrational, and self-centered. Forgive them anyway. If you are kind, people may accuse you of selfish, ulterior motives. Be kind anyway. If you're successful, you'll win some unfaithful friends and some genuine enemies. Succeed anyway. If you're honest, sincere people may deceive you. Be honest and sincere anyway. What you spend years creating, others could destroy overnight. Create anyway. If you find serenity and happiness, some may be jealous, but be happy anyway. The good you do today will often be forgotten, but do good anyway. Give the best you have, and it will never be enough. Give your best anyway. Because in the final analysis, it is between you and God. It was never between you and them anyway. And the reality is, for those of us that have done this or know this, know that you're going to face adversity. You'll face adversity in the deal. You may face adversity with your general partners. You may face adversity with passive investors or the seller or the commercial real estate broker or the title company or the surveyor or your lender, the lender's counsel. There's any number of ways in which your deal can go off track. But the reality is, I want you to breathe and you will get through this. You can do this if you follow the rules, take advantage of the opportunity, build your foundation and your team, and keep involved with deals. So you can follow us. We're out there. Thank God my parents gave me a unique name. You can Google me and find me, and I'd be happy to chat with any of you about any of your deals or how we might service you. But let's stop this and let's see what questions we might have.
All right. So somebody did send me a question, and they wanted to make sure I understood it. But if you've got, so a broker is a part of your team. So actually, a broker is a part of the GP team. Does that mean that if you have co-sponsors that come on to help cap raise, that they can be compensated for cap raising?
Not for the other co-sponsors. Only the registered broker-dealer has the ability to have a straight-up commission-style arrangement. And it's very rare, right? So most people that syndicate, they don't want to be a registered broker-dealer because they don't want to be regulated by FINRA. They don't want to have to jump through the hoops of all of the securities tests and the examination and keeping up with it. And then in the unlikely event that somebody does get upset and they file something, that is publicly available and it's broadcast out there. So we've actually had trials before with FINRA in the area of trying to battle unfounded or even baseless claims against registered broker dealers. So if you're thinking about being a registered broker dealer, seriously think about it, do your due diligence on it, but it's a long road.
We actually had considered that, but it was like, if it only helps one person and not multiple, then it doesn't necessarily seem worth it. Because I'm like, I went to school a long time, I can take a test. But it sounds like it's way more than that because you're taking on massive responsibility as well. So,
right.
All right. So I'm going to go back to the question that I was talking about earlier. I think a lot of us have it drilled into us that a 506B is the buddy. It means you have to have a pre-existing relationship with anyone that comes into your deal. And so I know that for us personally, we had people that were coming to us and it was like, well, we're not friends with you, so you can't be a part of this deal. Is that really how it works? Do you have to have a pre-existing relationship?
It's a great question. So there is no rule that says every single person that invests in a 506B offering, you have to have a pre-existing substantial relationship with. There is a rule that says, do not engage in general solicitation. The easiest way for a sponsor, syndicate, or operator to defend that they have not engaged in general solicitation is to say, I have a pre-existing substantial relationship with all of my investors. So if, and I use this example, this is an analogy, right? So I don't want people to say this is the way that we should do this. So if you have a 506B offering, that is a rule that says you should not engage in general solicitation, directly or indirectly. That means that you can't then whisper to friends, hey, go refer me other potential investors that could invest in my deal. No. But if I had, let's assume for an example, hypothetically, Warren Buffett says, Angel, I found out that you have an offering, that you're syndicating this. And you're like, wow, Warren Buffett. I don't know Warren Buffett, but he wants to invest. And I have a 506B offering. Would I allow Warren Buffett to invest in my offering? Yes, I'm allowing Warren Buffett to invest in my offering. Why? Because it's suitable for him, and he's an accredited investor. But the reality is, I don't know Warren Buffett. And you say, Warren, how'd you find out about my offering or this opportunity? Since this is a private offering that is not publicly available and was just circulated to people that actually you already have a substantial pre-existing relationship with. He said, well, Joe told me about it. And you're like, well, Joe shouldn't have done that. But let's assume that Joe did that without your knowledge, indirectly. And he went and told somebody about your private opportunity and they came to you and they were otherwise qualified to invest. As long as you can demonstrate that, meaning you can paper up that you did not engage in solicitation, that investor can invest if it is otherwise suitable for them to invest. But why?
So document those relationships. It's
but I always bring that one up.
Yeah. Well, it's weird though, because like most people, when you have a conversation with them, they don't give you like a receipt or like a transcript. You know, it's not like normal transactions. It's like what we were talking about. It's like, I don't know, real estate, right? It's brutal.
By most people, And I think the default has to be, you should really try to have a substantial pre-existing relationship with everyone, is because you don't want to have to think about, hey, did I paper up correctly that I didn't solicit this person I don't have a pre-existing relationship with? But that is the rule. The rule is don't engage in solicitation. If your file is audited and you're having to justify whether you did or didn't engage in solicitation, engaging in marketing efforts that are targeted to only people that you have a pre-existing substantial relationship with is not general solicitation from the SEC's perspective. So you can see how, if somebody comes to you through no knowledge of yourself and no efforts of yourself, directly or indirectly, they could invest. But I would not suggest that you set up your business plan with the thought that just strangers will walk up off the street to invest in your deal.
Well, and I guess that spurs me to two more questions. But the first one is that a friend told me, like, referred someone to me and said, it's okay, it's a professional referral. I started looking up professional referrals. I can't even find it anywhere. What the heck is that?
No, there is no such thing as a professional referral unless the professional is a registered broker dealer. So if the friend that referred somebody to you was just going out of their way to be good intention, they like, know, and trust you, and they just wanted you to see you succeed, right? That's fine. Okay, that's fine. The test though really is when you have to justify that you didn't engage in marketing or solicitation efforts, either directly or indirectly. And if in the unlikely event that your transaction were to be audited or looked at, you're going to have to be able to demonstrate, because you will have the burden, not the person that referred to you, you as the sponsor, the syndicator, the operator. You will have the burden to be able to say, I did not solicit any of the people that actually invested in our deal. I either have independent, substantial relationships with all of my investors, or they came to me through no solicitation of them. That's going to be your burden to have to demonstrate that.
All right. So
I remember we were asking about this just a couple weeks ago, because I was talking to a broker dealer and I was telling him, it's like, okay, here are the pieces of the puzzle that I know about compliance. And I think that I can't tell you anything if I have any 506B deals, but I don't know, because like, you're the one who's supposed to be able to evaluate and find out, like, okay, is this person out to lunch? Do these numbers actually jive with reality? And they're supposed to be able to be responsible for that. But I think that was a pretty clear answer, that if they are a broker dealer, then giddy up. You're good to go. So, good stuff.
I have another question, but I'm going to come over here to Emma's question, because Emma was saying that can you allow word of mouth referrals to invest in? Is that what you're considering, a word of mouth referral?
I don't know how the questioner is defining word of mouth referrals. There is a limited finder exemption. We call it the Paul Anka rule, that has existed historically. So remember Paul Anka, brilliant musician, right? Proud creator of romantic ballads from the 1960s and 70s. Well, maybe not. But the reality is Paul Anka in that fact scenario, invited a bunch of his rich friends to potentially invest in the deal. And the SEC got wind of it, and they looked at it and they examined it. And out of this came this idea of a limited finders or a referral rule, in which case the finder refers somebody, says, hey, Angel, I don't know what you're doing. I understand that you got some sort of deal going on here. I don't really know much about it, but I'm introducing Emma. Emma, meet Angel, and I'm out. And I get some sort of finder's fee. The SEC says that's fine. But imagine if Dugan in this situation is the finder and goes to Emma and says, hey, Emma, Angel's got a private offering. Here's her prospectus or her business plan. I really think it would be good for you. Do you mind if I introduce you to her? The SEC.
We're not talking about any specific Emmas, just so you know.
SEC does not want that. Emma has gone outside of this idea of Angel, meet Dugan, Dugan, meet Angel, and I'm out. And doesn't have anything to do with it. And you as Angel, if you're allowing people to do that for you, again, you are responsible for that. Meaning if the finder goes out and does something other than just simply introduces you to them, and even if they tell you that that's all they're doing, it's fraught with risk. That's why, in general, you don't see a lot of syndicators or operators around the country creating or allowing this kind of referral network to exist, because you can't really be confident, and you're taking upon yourself exposure of what they might do. So unless you have a true Paul Anka situation where somebody has a rich Rolodex and they just basically say, here's my Rolodex, I'm out, I have no idea what you're doing, but give me a flat fee or something like that, you're not going to fit squarely in that box. And so right now, we do not have a finder's fee platform or a legal compliant platform that exists. There is right now, as of October of 2020, there was a press release that the SEC kicked out that basically said, we're going to think about implementing what's called a conditional exemption for finders. That has not come into fruition. But if it does, then we can raise this issue potentially again, and that would be earth-shattering if that actually happens, because with some restrictions or whatever, you would be able to get referrals from people and pay them legitimately a fee. Obviously, once they're registered with the SEC, some sort of notice filing, we don't know exactly what the rules will be if it gets implemented. But currently, there isn't such a compliant framework that exists.
And to the best of my knowledge, that's still the case. Like we're right now here in 2022, like FTX is just falling apart. You've got, some spokespeople getting in trouble. Kim Kardashian, she's gotten in trouble a couple times with the SEC in the last couple of years as well, for similar things of basically endorsing financial investments without making the proper disclosures about what she's being compensated for. So none of us are securities attorneys on this call. Dugan, of course, is, but that's a recording. But to my knowledge, there's still nothing as far as like finder's fees that are okay. Like wholesaling, I think has a lot more cracking down going on. Right now, you're not supposed to be doing that because it's very similar to getting finder's fees.
Well, in some states, it's been outlawed.
Right, exactly. So there you go.
Wow. So, well, that brings me to another question, but I'll save that one. All right. So then it comes to, like, I've been told by a few different people that when you have a 506B, you can send it out to your email list. Is that you can blast it to your email list because those are people that you know?
If everyone on your email list is somebody that you believe you have a substantial pre-existing relationship with, yes. If everyone on your email list is not somebody that you have a substantial pre-existing relationship with, no, you cannot do that because you'd be engaged in general solicitation.
And that's where the pre-existing friendship and relationship thing comes into play.
You got it.
Oh, wow.
Exciting.
That's so many rules.
Well, and one thing that's coming up too is you don't necessarily have to use emails. You can also use social media direct messaging. And the thing that I'm not sure if the SEC is onto it or not, but I think you'd have to keep this in mind is if you use those automation tools to send out direct message blasts, I'm sure it's the same situation, which is you just have to be sure that you've got that paper trail showing that it wasn't general. They were already really it was the person vetted before the deal was presented to them, I think is the crux. So.
Rules, holy night. Number one, I'm angry that we passed up several $1,000s or several $100,000 because we thought we had to be friends. So that makes me a little angry, but you don't know what you don't know. But I'm going to back up just a little bit too. Oh, Angel has a substantial relationship with everyone. That's funny. But I'm going to back up a little bit because I heard recently that the SEC is looking at changing the accreditation rule to 10 million net worth.
Yeah.
Is that a for real thing?
No, that will not happen. Think about it. So what changes has the SEC actually enacted in the last 20 years? They've all been designed to enhance private equity into the system. Remember, private equity is what fuels the American economy, right? It's what fuels small business growth. And if you're trying to rectify a scenario or formula that has largely prohibited involvement by groups or people that have been largely disenfranchised, people of color, women, minorities, and now you're going to make the net worth for accredited investors $10 million, I don't think that there's a snowball's chance in hell of that ever being enacted. That's my personal opinion. Just based on, I don't think it would be good for the U.S. economy. Certainly would not be good for small business growth or for fueling the American economy or for what the intended role of the SEC is, and that is to sponsor capital formation. That is one of the primary pillars. There are three primary pillars, and one of them is to help formulate and sponsor capital formation into the system. And so if you make it more restrictive and not less restrictive, it doesn't help achieve what one of their goals are. So I don't believe that they're going to increase the minimum net worth from $1 million to 10 million for accredited investors. And I think it would be bad public policy. These are all apolitical. I don't care what political party you are in. These are all apolitical positions because investing is great for everyone. I think everyone should be able to invest, not just the corporations or families that have historically been able to do it or the richest of the rich. I think it's really meant for Main Street. So no, I don't think that's a long-winded lawyer way of saying no. I don't think so.
Emma brings up another point too. She's like, I hope they get the certified investor. What is that?
Yeah, Emma says the current SEC group seems to favor more regulations, though. Yeah, that's true. And with every time the administrations come in and new administrations come out, there's a changing of the guard at the commission level. But the people that have been there historically for decades have continued to be there. They are longtime good people, good public servants that are providing a service to protect investors and also help the U.S. economy. So I think that the SEC allows great transparency, meaning we're able to see a lot of these things that are kind of like they're spitballing and throwing things on the wall for discussion. but historically they move so incrementally slow that when changes happen, like the passage of the Jobs Act under President Obama, 2013, that was earth-shattering. But we had debated these things for like 20 years. So, all right. And so now, and then we have this idea of the conditional exemption on binders, even though they put out a press release on it in October of 2020. Here we are, 2022. We're still trying to figure out what's going on. Is this thing dead? Is it moving forward? Is it going to happen? Nobody really knows. But one thing we know for certain is that there's not any massive shift that has happened historically. So I don't expect the commission, regardless of who's at the top of the commission or who's in the White House or what their political affiliation is, I don't expect the commission to make these kind of earth-shattering moves rapidly in the system. So for purposes of what you're doing or your business plan or what you intend to do moving forward, I think the safest thing is just look at the current regs and go by that.
Awesome. So I think we have like 1 minute left. I got one last question here. Is there some kind of a rule or is there kind of a guidance on when you should move from a B to a C?
Yeah, so thank you for asking. That's a great question. A lot of sponsors and operators have asked that. Ideally, if you look at your investor database, you personally, and most of them are accredited investors, then go to a 506C. And if you can develop that framework, so the biggest reason which I found historically why people don't want to jump is they don't want to jump from the self-certification by private investors being able to self-certify that they are accredited to the having the uncomfortable conversation of, please open your kimono, show me how rich you are, prove it to me or prove it to this entity or vendor I've hired. That's uncomfortable for anybody to talk to rich people about that and to have that independent verification. But if you can get over that, if you can get past that, it's always, in my opinion, wiser and safer for you to be able to do 506C. But historically, what we see, the vast majority of syndication in the United States today is still 506B for some of those reasons. But the natural pathway for most operators is 506B for several years until your list is sufficient that it is mostly accredited. And then think about smaller raises potentially to try it out on. Don't go for the massive, we're going to go 50 million on this one, for your first 506C raise. Don't do that because it will be very, very difficult. But if you can slowly transition over, I think that's wise. And even though most operators are not seeing large conversions of potential stranger investors to actual investors through the use of advertising, right, which is one of the reasons why you would want to do a 506C, it still allows you another mechanism to communicate your vision, your purpose, your business plan with people that might not be in your existing network. So even though historically it hasn't resulted in a large amount of conversion, I think established operators that as they build their list and as they start to see what their matrix is inside, whether who's accredited versus sophisticated, those are the times when you might make the jump. But ordinarily, everyone is doing it the same way, and that is that people invest with people they know, like, and trust. Who knows us, likes us, and trusts us the most? Our family, people that love us, people that know us. That's why we're doing those investors first.
Yeah, that's awesome. We're a little bit over. I don't think anybody's upset about that, but thank you so much for being here today and just setting something straight, because especially for us, having just taken down our first active side deal, you don't know what you don't know. And sometimes you start asking questions and you're getting answers from people that might know the answers, but aren't going to CYA you if it goes to court. So
yeah. No problem.
Yeah.
My pleasure. Thank you for having me.
Thank you.
God bless you all.
All right. Have a great day. Thank you.
All right. So do we go straight to the doggy bag? That was quite the presentation. And I think a lot of people in the audience know how much time I've spent on this exact subject for the last few years, like the last 4 or 5 years. And still, I'm just soaking in the details again and saying, like, okay, what else am I missing? What else am I forgetting? It's intense.
Yeah. So I think
stuff.
My biggest takeaway is, number one, get you a really good SEC lawyer.
Mm-hmm.
But number two, if you're doing a 506B, don't talk about it. Like, don't put it out on socials. Don't just put it out there in meetups unless you know the people that are in your meetup. And don't put posts of it out there. I mean, if it's a 506, you can blast it everywhere. But with it being a B, like, I was just talking to a friend of mine earlier today, and she said that her meetup has been around for such a long period of time that the lawyers that she has spoken with have said, you're fine. But if you've just started attending a meetup, you need to really watch out, because that 506B, you can't just blast it out there. And I know that there are times when you've probably been at events where, say, a 506B was presented off the stage. That's not right. You cannot publicly solicit a 506B. And unfortunately, I have seen it done in front of large audiences. I had no clue who the people were on the stage. So why are they presenting a 506B where I can hear about it? I don't know them. And so I shouldn't have heard about it. It was an active deal. It had not closed yet. And so we just have to make sure that we understand what the actual guidelines are, what the actual statutes are, because we don't want to find ourselves in a situation where we're going to get pinned with it. So just watch out. Watch out.
Right. And it's really revealing when you see stuff like that. And that's why I'm always so excited about having a platform like this, the REI Rocks Review, where we can really dive into this stuff. And unlike a lot of people, we don't have to sugarcoat it. Like, we can actually get to the important details, because one of the things I personally want is I also don't want anybody who invests with us to get burned by these unscrupulous people.
Absolutely.
And so if you're sitting in there in the camera there, if you're at an event and you find out that people are pitching 506Bs, well, don't forget, like, the passive investors, the limited partners, they're the ones who are putting in the most money. So at the end of the day, if things get really, really bad, the only people who can lose money are the people with money. So you got to be really careful with who you're working with, because you don't want, their willy-nilly relationships to take down businesses that you're staking your future on. So make sure you know this stuff. Make sure you get along with people who actually take this stuff seriously. But I think there is a lot of behavior, like entrepreneurship is super difficult, and everybody's just trying to, piece something together. And that's why I think you see so many flagrant, abuses of these rules. And I know that there are some people who are like, that doesn't matter, because I'm never going to rip anybody off, and so I'm never going to get in trouble. Me personally, I've just seen way too much of humanity to have that amount of faith in everybody who I work with, what do you want to call it? Sustained rationality. It's like if you lose somebody in your family, if bad things go on, like, humans are not the same from one day to the next sometimes. So that's why, you got to make sure you follow the rules, make sure that everybody who's close to you is protected from it. So it's a intense session. There's some really awesome stuff. I'm so glad that you started all of these different summits. And I think that being a part of this family, being like getting the subscription, I think it's really, really important, because it also includes a free VIP access ticket to the live summits as they happened, as you're subscribed. And when you have this library of people to blast through, you can write down your questions. And then, even if you're too shy to individually interact with the different speakers, like who, all of them, they're always eager to meet more people. That's really the common thread of all the speakers is, like, some people are hard to book, but, they all are definitely interested in meeting people who are serious about this business and are actually looking to, move forward and do something. But it's such a great opportunity. And I really encourage people to hop onto that, because when you actually are able to join live and ask those burning questions, while they're already warmed up, you're going to see a level of excitement in those speakers that you just don't normally see. Because most speakers have to rehash the same stuff over and over again. And so when you come out with a question that was thoughtful, we're really happy about it. So that's my rant. But we're wrapping it all up. We'll be here again next Friday at 11 a.m. Eastern. We streamed this on LinkedIn, on YouTube, and also a Facebook page, which isn't the best one that it should be. We'll get that on something with a better branding for the Academy Presents. But please do make sure you hit the subscribe button, because that's the only way that YouTube will end up paying us for these this content. Because they really don't want
Yeah,
to.
we're only a couple 100,000 subscribers away from being able to monetize YouTube. But thanks.
Yeah, exactly. But it's Rome wasn't built in a day, and it's digital real estate, and we know what to do with it. The only way that's going to work is if there's actually something there worth visiting. So we really appreciate that. Jason, you've been chatty nonstop through the whole thing. You want to sign us off?
Well, thanks everybody for being here with us. I think that was a really good presentation. Glad we found it this week when we tried last week. So we do try to fix our mistakes whenever we can, and we'll see you next week.
Excellent.
Bye,
I
guys.
did see that bow tie, just like it's featured. Yeah, that's good stuff. We can get that as swag and stuff. We got all kinds of really, really awesome stuff on that swag channel. But thanks for coming. We'll see you again next week.
Bye, guys.
Bye.
Bye.